Today, we're diving into the ultimate crash strategies to survive or maybe even thrive. From the foundational basics to the slick, sophisticated moves. Hey, welcome back to Money Talks US, China, and beyond. I'm Chris Lee. Last time, we unpacked the market crashes and the triggers, those warning signs that keep smart investors up at night. Today, we're diving into the ultimate crash strategies to survive or may even thrive. Whether you are beginners or a market veterans, the episode got you covered. From the foundational basics to the slick, sophisticated moves. Here's the game plan. 1. Crash survival basics, your emergency toolkit. 2. Diversification and portfolio management, spreading risk like a pro. 3. Advanced bear market strategies, how to hedge or even profit when the market bleeds. Feel free to skip around with the timestamps below. And for deeper dives, check out our separate episodes. Here's the deal. Smart investors don't wait for the storm to hit. They're cautious when others are greedy and optimistic when others panic. When the bull market's roaring, like it's been for years now, that's when you prep. Because once the downturn slams, it's too late. So let's dive in. Alright, let's build your crash survival kit first. These are the essentials, the moves you master in good times so you're unshakable in the bad. Here's how to build your foundation. First, cash is king. Aim for 6 to 12 months of living expenses in a high-yield savings account or money market fund. Now it's pulling 4%. Pretty cool. No risk bets, just cold, hard, accessible cash. But here's the kicker. Keep some physical. Picture this. Greece, 2015. Banks capped withdrawals at 60 euros a day. People were begging for their own money. Or Puerto Rico, 2017. Post-hurricane. Power is out. ATMs are dead. Credit card, useless. Cash was king. And those who had it at home survived. Start with 2 to 3 months worth, say 5,000, 10 grand, depending on your lifestyle. For the wealthy, maybe toss in some physical gold or silver. It's not doomsday prep, it's just smart. It's survival when the grid goes dark. Next, anchor your finances. Live below your means, like way, way below. In a 2-income home, could one salary cover all the basics? Warren Buffett says it best. Don't save what's left after spending. Spend what's left after saving. Pay yourself first. Maxed out the 401k. Grab all the employer match. It's tax deferred, bankruptcy proof, and tough to rate early. Save at least 20% of your income. When the economy's humming, stack that war chest. Because in a crash, it's your lifeline. Now, debt. This is a silent killer in a crash. Leverage is a double-edged sword. Take the Hunt brothers in the 80s. They borrowed big to corner the silver market. When it crashed from 50 to 11 bucks, they didn't just lose. They went bust and triggered a mini crisis. For you, high debt means that you may have to sell your assets or even your home at rock bottom price to cover loans. Keep your debt-to-income ratio under 30%. And for investments, if you're laid back and completely hands-off, keep it simple. Warren Buffett's all-weather portfolio is gold. 90% in a low-cost S&P 500 index fund. He suggests the Vanguard. 10% in short-term Treasury bonds. It's hands-off, resilient, and lets you sleep at night. Finally, stay calm. If you've got cash, if you've got savings, if you don't have much debt, you're set. Panic selling at the bottom, that's the dumbest move in the book. In 2008, folks who sold missed the recovery. Don't be them. Deep breath, stick to the plan. So this is your foundation. Nailed it, you're already miles ahead when chaos hits. So got the basics locked? Awesome. Now let's level up with diversification, because smart investors don't bet farm on one horse. Here's how to spread your risk. Try this. 15% gold, 5% Bitcoin, 30% treasuries, 25 domestic stocks, and 25 emerging markets. Gold and silver, your crisis buddy. Over 100 years data shows it's likely to outshine stocks in the coming decade. Allocate 5 to 10% if you're hands-off, up to 20 to 30% if you're active. Check out Gold and Silver Deep Dive for more. In a crash, they may tumble a bit initially, but it'll come back faster and fly much higher. Bitcoin and crypto, yeah, it's divisive, it's controversial, I know. I'm a gold guy myself, but you cannot ignore Bitcoin's growing adoptions, with more major investment committees now nodding in its direction. It might be smart to sprinkle a little bit Bitcoin into your investment mix, just to hedge against the craziness of the financial world. Rule of thumb, 5% of your portfolio. We're going to also dive into Bitcoin in the next episodes on why and how, so stay tuned. Now for US stocks, pick winners: energy, defense, agriculture, healthcare, and education. These are the heavy hitters. Energy keeps the lights on. Defense rides AI and the global tension. Agriculture and resources feed us and build stuff. Healthcare is always a rock in any storm. And education is booming with online learnings. They're not sexy, but they're tough, perfect for weathering whatever the market throws at you. And dividend stocks shine here too. In 2008, the S&P 500 stock crashed 55%, but the dividend only dipped 21%. Focus on companies with 10 plus years of dividend growth, rock solid balance sheets that scoff at recessions, hunt for firms that kept boosting dividends even in past recessions. They are tough as nails. Plus, a solid yield and a low payout ratio keep you clear of overhyped bubble traps. Bonus, in a flat, dragging bear market, that juicy dividend income keeps your portfolio humming while stock prices snooze. Steady wins the race. Now, emerging markets might also be primed for a comeback. For over a decade, the US market has been crushing it, leaving EM in the dust. But lately, folks are buzzing about possible rotation back to the EM. What could spark it? Picture this. The US economy slows, the Fed slashes rates, growth stays sluggish, and the dollar weakens. Suddenly, those EM countries, they're burdened by dollar-denominated debt. Many of debts are in dollars. Get some breathing room, and then boom, they start to shine. Trump's election juiced up the dollar, delaying this flip, but many think it's coming eventually. Now, if a crash hits, sure, EM will tank too, but they might just rebound harder if that rotation already rolling. Now, here's the twist. If you are eyeing EM, you may want to steer clear of China in those index ETFs. Despite China's insane economic growth, I know, GDP up almost 8 times, A-fold since 2004. But its stock market, it's been a mess. The FXI ETF tracking China's biggest companies, trading on the US market since 2000 for longest, is up only 77% in 20 years. Compare that to the S&P 500's 390%, or India's INDA ETF doubling with much less GDP growth over only 12 years. China's stock market is volatile, it's dysfunctional, and if you bought in during the 2007-2008 hype, you're still underwater, as Kyle Bass said it best. Geopolitical risks, like confiscation in a worst-case conflict, don't help whatsoever. Sure, pros like SoftBank with Alibaba or Buffett with BYD struck gold picking individual stocks. But that takes serious skill and time. Going forward, with deglobalization and China's economic woes, those big wins are getting tougher to snag. That's why now investors are flocking into EM ETFs that ditches China altogether. The iShare MSCI Emerging Market ex-China ETF, ticker EMXC, with $15 billion in assets, is the rock star here. It's a way to bet on places like India and Taiwan without the China baggage. So, the US has had its moment. Emerging markets, minus China, might be next up. Here comes Treasury. Treasury, often people think it's your safe harbor. Treasury and stock often go, dancing opposite directions, especially when markets tank. Though that vibe broke in 2022's correction. We're going to talk about that separately. So, are U.S. Treasury bonds bulletproof safe? Kind of yes, kind of no. So, for Treasury, you've got different types. Bills, short, up to a year. Notes, Treasury notes, 2 to 10 years. Treasury bonds, 20 to 30 years, depending on how long Uncle Sam borrows your cash. They've always paid back in dollars, right? So no sweat there. But here's the catch. Inflation can eat your purchasing power alive. And long-term bonds swing wild with interest rates. Rates jump, they tank. From 2000 to 2023, the iShare 20-plus year Treasury bond ETF, TLT, tracking the 20-30-year bonds, crashed from $155 to under $80. Ouch! Nearly 50% gone. But in 2008, long-term bond rates dropped and TLT price soared. Safety pays. Short-term bills under a year, though, they're rock solid, zero risk, cool 4% yield now. Warren Buffett parks his $334 billion there, $334 billion, all in short-term Treasury. But when rates drop to zero in recessions, they barely pay. Right now, the long bonds at 4.5% yield or rates could shine if a crash hits. More on that in our next deep dive. Stay tuned. Now, let's talk about the magic of portfolio balancing. There are two ways to keep your investments on track: automatic rebalancing and active allocation. They're like cruise control, you hit the button, versus steering the wheel yourself. Automatic rebalancing is your set it and forget it move. When stocks crash, many folks panic sell at the bottom and miss the rebound. Don't do that. Don't do that. Instead, stick to a plan. Say if your target is 60% stocks, 40% bonds, the basic 60-40 portfolio. Stocks soar, sell some. Buy bonds to reset. Stocks tank, flip it. Sell bonds, grab cheap stocks, simple. No crystal ball needed. And it keeps you steady. Historically, this diversification cuts recovery time. Think 3 years for a 60-40 mix versus 4.5 years for the S&P stocks to recover, like they did in 2008. It's a cool way to ride out storms. Active allocations, though, that's for the hands-on crowd. You tweak your mix based on what's hot, what's not. U.S. stocks overpriced? Trim them. Emerging markets dirt cheap? Load on. Take the Ivy portfolio. 20% each in U.S. stocks, international stocks, REITs, commodities, and treasuries. If something dips below its 10-month average, you bail it to cash, sidestepping 2008 worst. It's beaten the S&P 500 with less drama. Jack Bogle, the index king, did this in late 90s. Slashed the stocks just before the tech bubble popped. Automatic keeps you balanced, no fuss. Active lets you swerve around potholes if you've got the tools and guts. So, diversify and rebalance. Again, 15% gold, 5% Bitcoin, 30% Treasury, 25% domestic stocks, and 25% emerging markets. Keep it autopilot or tweak it to your gut. Balance is key. You're not just surviving, you're winning. Now, ready to play offense? These advanced bear market strategies aren't for everyone, but they can shield you or even profit when markets tank. Let's get bold. Inverse ETFs, short selling, and options. I'm going to keep it simple and fun. Inverse ETFs are like a mirror to the market. Take the ProShare Short S&P 500, SH. When the S&P 500 falls 1%, SH rises 1%. It's a neat trick, using derivative futures contract to move the opposite way. And you can buy it with just a brokerage account. No fancy stuff needed. It's a shield if you're worried about a crash. Back in 2008, it could have saved people from dumping their 401k at a loss. Your downside, only the amount of the money where you invest. But here's the catch. Stocks tend to climb long term. And even if it stays flat, the SH will lose value, lose money, because it has decay effect from daily resets and expense ratio higher fees they're charging. It's great for a quick hedge if you spot a bubble imminently, but you've got to time it right. And then short selling is like betting against a stock. For example, you borrow Apple shares at $200, sell them and hope to buy back at $150 and pocketing the difference, the $50. If the Hunt brothers had shorted silver instead of buying it, they could have made billions when it crashed from 50 to 11. You can zero in on specific stocks, assets, even ETFs, and margin boosts your firepower. But here's the catch. If Apple shoots to 300 or above, your losses could be huge and even unlimited. All the while, you are stuck paying the borrowing fees of those stocks. It's a bold move. Huge rewards if you nailed it, but a disaster if you're wrong. Now, here comes the options. The 3 cool option plays. Number 1, sell options for income. Think of it as renting out your stock for some quick cash. You've got, say, 100 shares with a covered call. You sell someone the right, not the share itself, the right to buy the shares at a set higher price later, and they pay you a fee. It's called premium. If the stock stays cool, chill, didn't go up, you keep the cash. But if it jumps, they take the shares. They bought it because you agreed, but you're still up because you sell share at a higher price. Or with the cash secured put, you've got cash ready and sell somebody right to offload their shares to you at an often lower price. They pay you the premium as well. So if it doesn't dip, you pocket fees. Sweet. And if it does drop, you bought the stock cheap. So it's like a collecting rent in a sleepy market, like a Japan's Nikkei for decades. Sell puts or calls to pocket steady cash. It's a slow burn, slow churn, but it keeps money flowing. 2, protective puts. Think insurance. Say the Apple is at $250 and you pay $4 to get you a put to sell at $240. If it crashes to $200, that $4 turns into $40. Awesome protections. But if you time the crashes wrong, most put options expire worthless. So timing is key. Third, the smart combo option collar. So you buy a put to limit losses. On the flip side, you sell a call to fund it. Here's the deal. Buy a put to sell the stock at $240, your trap door if the stock plunges, and then sell a call to let somebody buy it at $260 later, using that cash to fund the put. It's like a parachute for falls and a ceiling for wild climbs. Why it's cool? It's cheap. The put option protection, the insurance, is almost free with the call option money in your pocket. And the downsides? Capped gain. So if Apple soars to $300, you're stuck at $260 because you already agreed you're going to sell somebody at $260. It's a bit tricky to nail the details. These are power tools. They can protect you or cash in when the markets dip, but they're definitely not foolproof. Inverse ETF is easy, but fade. Shorting risky, but targeted. And options, especially callers, offer balance if you played it smart. Timing is everything. Missed it or get it wrong, you are the Hump Brothers all over again. We're going to deep dive into those tools soon, so stay tuned. There you have it. Your crash survival playbook. Save big, live small when sun is shining. Keep an eye on rates and the recession vibes. Then spread your bets. Gold, silver, Bitcoin, US and EM stocks, bonds, you name it. And rebalance without chasing the crowd. Skip hype buys and the panic sells. Grab cheap assets when others won't. And if you are feeling slick, toss in some hedging. You're now armed to weather the storm. The key? Prep when times are good. Stay calm when they're not. And pounce when others flee. Thank you for tuning in. Money Talks US, China, Beyond. Hit that subscribe button and bell. Drop your thoughts below. What's your crash plan? Next time, we're going to unpack some of these strategies deeper. Until then, stay sharp, because in markets, the prepared don't just survive, they thrive. See you soon.